You weren't supposed to hear this. What I'm about to say isn't on CNBC, it's not in your trading app notifications, and it definitely isn't explained in the way you're about to hear it now. Because right now, beneath the noise, beneath the headlines, beneath the fake optimism and manufactured panic, something is shifting in the global financial system. And if you don't understand what's really happening with gold, crypto, and stocks at this exact moment, you're not just uninformed. You're exposed. You're standing in the open while the people who actually control the money are already moving into position. This is one of those moments where knowledge feels dangerous. Like once you see it, you can't unsee it. If you want real financial truths they don't teach, hit subscribe and turn on notifications. You don't want to miss what's coming. I'm serious. Because what we're about to break down isn't just about markets. It's about psychology, power, and how wealth silently changes hands while most people are distracted by price charts and headlines designed to keep them emotional, confused, and reactive. Here's the uncomfortable truth. Global markets feel brittle right now. Not volatile in the flashy, obvious way. Brittle. Like something that looks solid until you apply just a little pressure and it suddenly cracks. Assets that are supposed to be stable are wobbling. Speculative assets are losing momentum. Stock market rallies can't seem to hold themselves together. Gold is pulling back after years of strength. Crypto feels tired, almost hollow, and equities are stuck in this strange limbo where nothing collapses, but nothing really works either. Most people look at this and see randomness, bad luck, noise, but that's exactly what they're supposed to see. Because this isn't random. This is a coordinated repricing of reality driven by one word that controls everything, even if almost nobody talks about it correctly. Liquidity. Not money, liquidity. The ease with which money moves, multiplies, and takes risk. When liquidity expands, everything feels easy. When it tightens, the masks come off. Let's start with gold, because this is where the confusion really begins. Gold is supposed to be the ultimate safe haven, inflation hedge, chaos insurance, the thing you run to when the world feels unstable. And yet here we are, geopolitical tension everywhere, governments drowning in debt, currencies being quietly debased, and gold is pulling back. That alone should tell you that the surface level explanation is a lie. What's actually happening is far more uncomfortable. Gold didn't fall because risk disappeared. It fell because fear was already priced in. For years, gold absorbed every macro anxiety you can imagine. Inflation shocks, banking stress, war, recession fears, institutional money piled in, central banks hoarded it. Retail investors were told it was the smart, safe move. And when everyone is already hedged, when fear becomes consensus, the trade is crowded. That's when the exit starts forming, quietly, long before the headlines change. But there's a deeper mechanism at work here that almost no one talks about, honestly. Real interest rates. Not the rates you hear about on the news, not the ceremonial rate cuts everyone celebrates. Real rates. Rates adjusted for inflation. And despite rate cuts, real yields are still positive. In some cases, they're rising. That changes everything because gold doesn't produce income. It just sits there. When real yields are attractive, holding gold has an opportunity cost. Institutions don't think emotionally. They think in relative terms. If they can earn real yield elsewhere, gold becomes less urgent. Not useless, just less dominant. And then there's the quiet slowdown no one wants to admit matters. Central bank gold buying. For years, central banks were the invisible floor under gold prices. Massive, consistent demand, a signal that something was wrong with the system. But now, that pace has slowed. Not stopped. Slowed. And in markets, acceleration matters more than absolute levels. When a major buyer stops accelerating, prices become vulnerable. Gold hasn't lost its role. It's lost its automatic support. That makes it sensitive, exposed, human again. So gold's pullback isn't a failure. It's a rotation. Capital doesn't disappear. It moves. And right now, it's rotating toward income, toward yield, toward places where money can work instead of just hide. That's not comforting. That's strategic. Now let's talk about crypto, because this is where the psychological warfare gets brutal. Crypto exploded when liquidity was abundant and expectations were euphoric. Rate cuts were coming. Money would be easy again. Risk would be rewarded. And when those expectations got dialed back, when reality didn't cooperate, the air came out fast. Billions in leveraged positions liquidated. Support levels snapped. Sentiment shifted from confidence to confusion almost overnight. But this isn't the old crypto winter. This isn't total collapse. This is something more calculated, a reset, a shedding of excess, a reminder that Bitcoin, for all its mythology, still behaves like a risk asset when liquidity tightens. Whales understand this. Institutions understand this. Retail investors are still arguing on social media, emotionally attached to narratives while their positions bleed slowly. ETF flows have cooled. On-chain risk appetite has faded. The explosive momentum of the last cycle is gone. And that's not an accident. That's what happens when speculative liquidity dries up. This phase isn't designed to destroy crypto, it's designed to exhaust people, to bore them, to scare them just enough to make them doubt their convictions. Because the real accumulation doesn't happen during euphoria. It happens during uncertainty, when price stops being exciting and conviction gets expensive. And here's the part that feels illegal to understand. Every major crypto cycle has this phase, a moment where the crowd loses interest and the smart money starts paying attention again, not loudly, quietly, patiently. This is where narratives go dormant, where media coverage fades, where retail leaves, and where positions are built for the next repricing, not the next pump. Now look at stocks. This is where the illusion of stability is strongest, because nothing has collapsed. Yet, earnings haven't imploded, banks aren't failing on live TV, but valuations are compressing slowly, methodically, because real yields are still elevated, because growth is slowing, because margins are normalizing, because the fantasy of endless expansion is colliding with the math of higher discount rates. For a decade, investors had no choice. Cash was trash. Bonds were jokes. Equities were the only game in town. That forced money into stocks regardless of valuation. But now, alternatives exist. Cash yields something. Bonds yield something. Suddenly, equities have to compete again. And when they do, prices adjust. Not through panic, through gravity. This isn't a crash environment. It's worse for most people. It's a grind. A slow realization that returns will be harder. That buy the dip doesn't always work. That narratives don't override math forever. Liquidity is shifting. Capital allocation is changing. And when that happens, the herd gets confused. This is where psychology becomes the real battlefield. Fear makes people sell at the wrong time. Greed makes them chase at the top. Media amplifies both. One day it's doom, the next day it's hope. Emotional whiplash keeps retail reactive, exhausted, dependent on external signals. Meanwhile, whales don't consume news. They observe behavior. They wait for mispricing created by emotion. What you're witnessing right now is a silent wealth transfer. Not dramatic, not obvious. Capital moving from impatient hands to patient ones. From emotional traders to strategic allocators. From people who need certainty to people who can tolerate ambiguity. This is how resets happen without crashes. This is how systems cleanse excess without collapsing. The twist is this. The environment everyone fears is the environment that creates future opportunity. When expectations are low, when narratives are broken, when liquidity is tight, that's when assets reprice to reality. And reality is where long-term returns are born. Not at the top, not during hype, but during confusion. The warning is simple but brutal. If you let fear dictate your decisions, you become liquidity for someone else. If you chase comfort, you miss positioning. If you confuse noise with signal, you'll always arrive late. The system isn't designed to reward understanding. It's designed to exploit emotion. So here's the question you need to sit with. Are you reacting to what you're told is happening, or are you positioning for what's quietly unfolding beneath the surface? Because most people will never understand this. They'll feel it later and wonder what happened. You'll know it happened here. The real power isn't predicting the next move. It's understanding the cycle. Liquidity expands. Liquidity contracts. Assets reprice. Narratives reset. Wealth moves over and over again. The only variable is who's paying attention. This changes how you see money in reality because it exposes the game, not to scare you, to free you, because once you see how fear and greed are engineered, you stop being controlled by them. So here's my question for you. Do you think we're closer to the end of this reset or just getting started? Drop your answer in the comments, send this to someone who needs to hear it, and if you want to stay ahead of the narratives instead of trapped inside them, subscribe and turn on notifications, because what's coming next is where the real positioning begins.